Frank Curzio here, another live video. Sorry if we had a little bit of a disconnection before, but I wanted to bring this point home. It's very important. And if anyone has any emails or questions, frankcurzioresearch.com. But I want to talk about today's action in the market, how, it was up 950, then we came all the way back down, and now we're up around 300. So a lot of people are confused. And I wanted to talk about the sell side analysts because they're very, very far behind. When you look at Apple, which I posted on Twitter, I think it was yesterday, the day before, there's 27 analysts have a buy rating on it in January. Not one of them downgraded the stock yet, even though Apple completely removed their guidance from the market. I mean, it should be a neutral rating, not a buy rating when you really don't know those earnings. But I want to put things in perspective for you if you're thinking about buying this market, which is very important. So in September, if you're looking at the earnings growth, they were expecting for Q1 2020, that's our next quarter that company's going to report, it was 7.1%. In December, China's slowing, coronavirus, it fell around 4%. Today, with everything factored in, they're only expecting a 0.1% decline in earnings. I think that's absolutely insane. So if we're looking at that percentage, they're only expected basically flat. Earnings are going to come in around $39 for Q1, which is insane considered China was completely shut down in February. It's one of the biggest growth markets globally. We're seeing no travel. If you look at earnings estimates for energy companies, they're still expected to grow or decline by only 1.3%. So a lot of these numbers haven't even been updated even after everything that happened with oil. Financials only expected a 2% decline. It's going to be even more than that. Again, I have access to this information. But based on the number that they think, we're still trading at 18 times forward earnings, right, in the S&P 500. That's very, very expensive. I know interest rates are low, but we didn't grow earnings in 2019, and we didn't grow earnings. We're not going to grow earnings in 2020, and who knows for 2021. That's the scary part, right? So it's very hard to forecast. Companies are not letting us know. But for some reason, analysts believe that our earnings are going to be flat. I personally think they're going to be down at least 20%. Europe reports ahead of us when it comes to earnings. They're seeing like a 25% earnings decline year over year for their first quarter. We're probably going to see the same at least. Again, a lot of this isn't factored in where energy, infrastructure, travel restrictions. I mean, it's pretty crazy right now. We're going to see a pretty big decline in earnings. If I take a 20% decline, 20% less than that number, I come up with $31 about. And based on that $31 number, we're trading right now, the S&P 500, at 23 times forward earnings. To put that in perspective, that's the most expensive valuation. Now, since the credit crisis, but you have to go back to the tech bubble, right? Pre-2000. That's how expensive we are right now based on earnings. That's a conservative estimate. I really think that's conservative. Why is that so important? For those of you who don't know, sell-side analysts are the institutions, the JP Morgans, Goldman Sachs, Merrill Lynch's, Morgan Stanley's. They provide earnings estimates for all the companies. And say if there's 20, 30, 40 sell-side firms covering Apple, they'll take, the mean estimate. And then that's how they get the estimate on TV when you're watching CNBC. So say expected earnings of $1, and if they report higher than that, the stock can go up. They report lower than that, it's going to go down. But that number is a sell-side analyst. Right now, this is important because they haven't adjusted their earnings yet. I don't know if these guys are on vacation. I don't know if they just don't understand because this is the first time it ever happened. They should be going to neutral ratings on almost every single stock, especially every company that removed their guidance since they don't know. I mean, there's pockets that you could buy now, all right, where it makes sense. If you're looking at companies that were cheap ahead of the market, maybe the Intel's, IBM's, they're trading a 20% discount before this. Before the coronavirus, you're looking at healthcare companies. Now it looks like Bernie Sanders, we're going to get a confirmation today with politics, more delegates and a lot more states reporting. Probably going to be for Biden. We're going to see that push out. And we're not going to see, Sanders come in, which is very good for healthcare. I'm looking at gold producers are not really expensive here. Also, tech companies with little exposure to the coronavirus, and Microsoft a little bit, but still a lot of it they just get at the cloud. They're going to generate so much profits. Amazon, Adobe. These are companies that I'm looking at, but most of them we're taking S&P 500. Guys, be very, very careful. There's no rush here. I've been saying that the whole entire time. And for the past 3 weeks, I've watched TV. People have been telling you what to buy, where to go, and everything is down another 20%. Just be patient. Don't panic. It's not panicking. If you're selling things that are expensive, you're fine. You avoid a lot of this, especially if you've been listening to us, which is good, right? Feel good about that. You should be sitting on cash looking for ideas. That's the next step in my research. That's what you're going to see in my newsletters, Curzio Research Advisory and Curzio Venture Opportunities, where I'm looking for new ideas, new sectors. What has come down tremendously? Stocks that don't have like Intel and IBM, right? So they've come down just as much as the rest of the market, but they were already trading at a huge discount to the market. So just things like that, this way I can get prepared because we are going to see fiscal stimulus. We're going to see more monetary stimulus, the Fed cutting rates aggressively, going to see interest rates come down. And their hope, as well as my hope, is that at the time of this, in the next 2-3 months, we're going to see the coronavirus risk subside. If we see that, we're going to see a really booming market probably 6-9 months from now. But right now, you have to stay in the sidelines, be very, very careful. And hopefully, the sell-side analysts come back from vacation because they haven't updated their estimates, and it's terrible. These companies are going to miss earnings so bad first quarter unless we see these guys update their estimates. Hopefully, we'll see that over the next couple of weeks. I'll report back to you soon. Take care.